An absolutely crazy week in the markets. Guys, my name is Hamilton. I'm here with the Trading Initiative. And in today's Markets in Focus, we're going to wrap up this week ending January the 12th, 2024. First things first, markets are closed Monday for Martin Luther King Jr. Day. Please don't show up. But if you do, well, I hope you enjoy sitting in Discord by yourself. The markets are not going to be there to soothe you and steal your money. So without further ado, let's actually get into this week's action. As you can see, it's a bit of a toss-up here, right? We're right around all-time highs with a lot of the different major indexes, and that's going to cause some choppiness as we work our way, which we believe, up and into all-time highs. IVW, your growth ETF, your biggest winner here on the week, up 3.74%. The Q's up 3.3%. S&P 500 up 1.82%. So the two most important indexes, if you will, up on the week. But we are once again pressing into all-time highs, and it is quite choppy. The aggregate bond ETF is up as well. Mid-caps up. Treasury bonds slight up. Russell 2K slight up. We're going to look at that in a second, but definitely some churn there in the Russell 2K. Our thesis at the end of 2023 has changed only a week and a half in regards to small mid-caps. We're going to talk about that in a second. Down at the bottom there, I want to point out Bitcoin down 2.5% on the week, but is it really down a whole lot? Actually, think about the crazy journey it's had this week. BTC ETFs have recently been approved. There's going to be a lot of volatility within the underlying asset as institutional footprints look to kind of dictate the price action at the very minimum in the short term here, introducing a lot of volatility. We're going to look at the chart in a second, but is it really that bad? We're going to look at it. Crude down 1.19%, copper down 1.21%. Little hint here, commodities look like they might be breaking to the downside, and China is also breaking to the downside. Is there a little bit of a similarity in regards to commodities and China? Potentially. Not saying 100% sure, but definitely potentially. All in all, a pretty okay week. Not a whole lot going on. Pretty okay, though. A lot of the mega cap tech stuff really started to run and saved some of those indexes, some of the breadth stuff. Not terrible, but not great, right? We're consolidating around all-time highs. This is kind of what we expect in these types of situations. We would have loved the definitive all-time high breakout. We might get it still. Who knows? As early as next week, but right now we're kind of waiting here. So I want to point out some sector, industry, and some market cap strength here. If we look at what are the leading sectors going back the last 3 months. So then we're going to capture the tail end of that corrective phase from late July through late October. We're going to roll it into, obviously, current date, last 3 months. Tech, financials, and real estate. I mean, those are the big three. I think the biggest surprise is financials still holding on. You know, Q4 of 2023 saw financials outperform everything, actually. But it is surprising to see them hang on into the beginning of 2024. I'm personally long JP Morgan, KKR, a couple other names as well, which we're going to talk through in a second. We like this particular sector coming into Q1. Rates are coming down. Banks are generally going to bounce off of that. And JP Morgan, the most important bank stock in the world, is breaking into all-time highs. They just reported earnings. We broke out into all-time highs, pulled back. We'll look at that in a second as well. We want to continue to remain long the areas of the market that are outperforming SPY with the most weight. So financials and tech. Your real estate plays are going to be a little bit harder to come by on the options chain due to liquidity issues. But for sure financials, for sure tech. We're starting to get long some industrials. We're starting to get long some healthcare, which we're going to look at in a second. Communications, consumer discretionary here and there. But realistically, it's tech and finances. I mean, that's what, if you're in TTI, you know that's where we're overweight right now, or in the middle of becoming overweight right now. We're assuming that 2024 is going to be very bullish. I'm not going to go through that thesis. A separate video is going to come out after this Markets in Focus. I highly encourage you to watch that. It's our 2024 kind of outlook where we outline our bullish thesis there. It's really good stuff. Highly encourage you to check that out. So we like tech, we like financials, we like industrials, we like healthcare, we still like communications and discretionary. They're just underperforming right now. We look at the industries that are outperforming. Home builders, ITB, number one. Makes sense. Real estate's up. KRE, number two. Has come down slightly since the middle of December, but still on the 3-month chart here, it's overperforming. SPY, we've got to continue to stay long KRE where it makes sense. Regional banks, we have positions in Key, we have positions in CUBI, we have a newer position in TFC, a couple of guys inside of the group. We still like regional banks through quarter one of 2024. We'll see if they continue to work well. Software and internet still working well. You'd expect that, obviously, with tech still moving up, semiconductors as well. Nothing new here. In regards to transitioning to a different style of play, right? We're still long regional banks. We're still long Internet software, we're still long semis, although exposure has been limited. We're looking to enter new positions here as we did take profit end of Q4 2023. But let's talk about probably the most, the most fun area starting to break out. It's your biotechs. Your biotechs are starting to break out. So healthcare, as we're going to look at in a second, pressing into all-time highs, and your biotech is going to be that higher beta area of healthcare. Biotech stocks finally starting to break out after a massive 2-year consolidation. We're seeing it both on an absolute and a relative basis here. Those biotech plays open up a lot of opportunity for the traders that were unable to grab some of that stuff over the last 2 years. Biotech has been an incredibly hard trade since 2022. Here it is, the beginning of 2024, and the market is starting to throw a couple of them on our plate, starting to see more and more on the scans, right? So we're looking at potentially owning those very shortly. Over the last 3 months, I do want to point out, market cap has changed extensively. I talked about right at the very beginning that our thesis here in 2024 for IWM and small caps and mid caps where, hey, that's probably going to be where a lot of the opportunity comes from. We saw that huge breadth thrust in small caps in Q4 of 2023. We went from a 52-week low into a 52-week high in the fastest amount of time Russell 2K has ever seen. We broke above 198.5 to 200. It looked like we were into a stage 2 breakout, and here we are just a week and a half, 2 weeks later, right back into the middle of the range. Son of a bitch, right? And as you can see, going back to the end of the year, the relative performance against the S&P 500, not only value, but smalls and mids in particular has declined. Now, it's not to say that smalls and mids are completely out. We still have some exposure in select areas. We're just not looking to allocate a large portion of our scarce capital towards that area as long as it's underperforming the S&P 500, especially if large cap growth is once again starting to potentially bounce. This does not look great, right? We're not aping into Apple and Microsoft with huge positions right now. But if 2023 ends up being relatively the same, if 2024 ends up being relatively the same as 2023, where, mega cap tech stocks really took the cake, that's where we're going to be. That's exactly where we're going to be. We're starting to see some of that rotation back out of smalls and mids as IWM is back within the range, and financial institutions and retail are starting to buy large cap tech stocks, mega cap tech stocks again. That's what we got to do. That's what we got to do. I'm not necessarily complaining. It does make it a little bit more boring, right? The basket of stocks available shrinks a lot. I definitely thought that 2024 was going to be more of a stock pickers market where the indexes kind of underperformed and it really gave some underweighted areas of the market an opportunity to run. We're still only like 2 weeks into the market, guys. I could be completely fucking wrong within the next 2 weeks. I have no idea. I'm just a trend follower. I just follow prices like a dumbass. As of right now, we are limiting our exposure to smalls and mids because they have been coming down against the S&P 500, and we are opening up new positions in large cap tech stocks, large cap financial stocks, etc. That is your Koifin analysis. We're going to skip Twitter today. I don't think there's really anything worth going over Twitter. Twitter's a fucking cesspool the last 2 weeks of people screaming that there's a new bear market coming. Probably not. People are screaming that the world's going to end due to World War III. Probably not. I just can't deal with it. So we're just going to move on. I don't even want to deal with Twitter. Shout out to the guys on Twitter that aren't doomsday preppers, that aren't fucking idiots. I commend you. Let's look at SPY first. We're going to look at the Dow Jones, the Q, SPY, IWM. We're going to look at semis, healthcare, financials, the dollar, bonds, some Bitcoin action a little bit here. Let's start with SPY. Does this, I want to ask you a real question. Like, just be honest with me. If you looked at this and you didn't know what the ticker was, would you or would you not be buying this rounded bottom breakout? Probably buying it. You're north of the 200-day moving average. This is an all-time high. This is a rounded bottom. There's a clear overhead horizontal resistance area to risk on at. I mean, this is a great setup. It just so happens to be the S&P 500, boys. We're going to go to all-time highs. I want to save that banter for another video, but we're going to all-time highs. I mean, that's it. That's the bullish outlook for us in 2024. And that's what the charts are saying right now. We're consolidating right underneath an all-time high close. We definitely expect within the next few weeks we will have cleared this 480 area and we will be on our way to 500. This looks fantastic. Let's look at the Dow really quick. The Dow looks even better. You can see that we were doing some work here. The monthly charting session inside of TTI, we were kind of explaining some support resistance flips, basic stuff on the Dow. But what normally happens when we get these support resistance flips? They open up new opportunities to continue to shoot the trend to the upside. We don't think this is any different. We think the Dow is going to be north of 40,000 sooner rather than later, right? We think it's going to be 40,000 before 36 again, before 35 again. Absolutely. It's a great setup on the Dow. And keep in mind, the Dow is not overweight tech like the S&P 500 and the Qs are. Yes, even the S&P 500 is overweight tech, right? The Dow's two largest components are financials and healthcare in that order, then tech. So this is kind of a better, truer snapshot of the overall health of the market. We're getting some healthcare and some financial shining through there into all-time highs. This is great, right? Let's look at the Qs, tech-dominated Qs. How is this bearish? I don't know. Just come on. Round and bottom, all-time high. We're already at all-time highs. So we're going to continue to go up? Probably. I think we probably are. And this is where a lot of that tech, semis, internet, software names, like specifically the large caps and the mega caps, that's this particular chart shows where they're shining through. The Qs are at all-time high. Your smalls, your micros, even your mids they're not at all going to reflect on this chart whatsoever. Actually, the weightings are so insignificant that they're not even going to be inside the ETF. Now, the industry groups are, right? Apple and Microsoft, software-related companies, that IGV ETF. But IGV also holds some smaller companies that the Qs don't. So it's nice to see right now the Qs are at all-time highs. We have a general idea that we want to continue to be long large cap, mega cap, tech stocks. Tech, remind you that tech has lots of different industries inside of it, semis, software, internet, other ones as well, by the way. This is an incredibly bullish chart. We want to continue to be long as best we can within this trend here. But let's talk about the trend that isn't trending, small caps, right? So we were talking about the end of 2023. We expected this spot right here to be a launch pad up towards 220. We expected smalls and mids to join the party. It was time. And look how quickly that pipe dream was taken away from us. Back underneath 198.5. I want to see it at least north of 198.5, 200 before I start allocating some capital to this part of the area, right? We're back within the range. It's a bummer. There's still some spots, specifically small and mid-cap software stocks. They're still running. They're still giving us bounces, and we are still allocating there, just not as heavily. And we're not as ready to pull the trigger on a lot of these trades breaking out of stage 2 if the market cap in general is just not being bought right now. We want to see the market come in and buy this shit. 2 years. It's been stuck in this range and we're back in it. Listen, we're just going to take the foot off the gas, take a step back. We'll get back in when it makes sense above 198.5 or 200. Semiconductors pressing at all-time highs. I don't have to tell you, NVIDIA's at all-time highs. This is probably the most important industry group within the entire market. Semis. That's it. Last year it was the most important. This year's probably it's going to be the most important in a bull market. This will probably continue to be the most important part of the market until something new comes out, specifically with this AI bubble. The AI theme, the AI craze, it's going to run multiple years, guys. It's not just like a 6-month or a 12-month thing. It's going to run multiple years. It's going to completely revolutionize a lot of our lives for better or worse, and it's going to be spearheaded here on this chart, the semiconductor chart. Obviously, the most popular, the most famous chart right now is NVIDIA at all-time highs. Nice 5-month breakout. Who didn't see that coming? Not saying it was an easy trade. It was super expensive and choppy around 500, but I think everybody with a brain thought this was breaking above 500. Anybody that looked at charts with any sort of actual, couple IQ points that they could rub together knew that this was going to break. It wasn't, and if it was a win, doesn't make the trade particularly easy, but I think we all assumed that this was going to resolve to the upside, and obviously this is going to skew semiconductors up, and that's going to skew the Qs up, right? So we like NVIDIA moving up and to the right, currently trading around 550. We have a price target here at 555 off of the 500 pivot. Next one up is in between 6 and 650. We'll see how close we get up there. But this is great for the overall industry. We like semiconductors. We like NVIDIA breaking out. It generally makes the rest of the trades a little bit easier when semis or NVIDIA rather, is breaking out. Let's look at healthcare really quick because they just reported today, the largest company within the healthcare sector reported today, United Health Group. Two largest companies, United Health Group and Eli Lilly. Both of those are sitting around all-time highs. UNH got popped down for 4% today after earnings, but still hovering around all-time highs. This is an all-time high breakout above like 141, 142 within healthcare. It's been basing here for 2 years. We think there's going to be an opportunity to trade this specific sector. I don't think it's going to be as easy as people expect because this sector, everybody can look at this and go, yeah, it's probably going to go up. It's probably going to go up. And that makes trades crowded and lots of whipsaw type of price action. We do think there's going to be an opportunity here, but what we like in particular is that biotech space that we were just talking about. So I'm going to pull that up in a second, but I want you to notice over 140, there's big blue skies. There's no volume because it's an all-time high. Lots of different industry groups within healthcare in particular that you could potentially play, medical devices, biotech, nursing homes, etc. All of them kind of have their own little trajectory. Healthcare is a gigantic sector here, but United Health, Eli Lilly, if you want to look those up, both all-time highs candidates and both the two largest components of the healthcare sector. Here's that biotech industry group. We use either XBI or IBB. you know anything about Stan Weinstein, Richard Wyckoff, this is a stage 1 accumulation. We have patented accumulation there by financial institutions. We're just looking for a clean break above 90, 91, something like that. Currently trading 90.59. If this goes, I'm going to tell you guys right now, if you run any sort of scanner whatsoever, biotech is going to be dominating this every single day, unless you have some sort of market cap restriction on. I mean, there's mid caps running every single day, breaking out into all-time highs, or all-time highs as well, but breaking off of lows. What we're looking for is just to gain some partial exposure in the biotech space. If this does actually break out, we can look at the other ETF as well, IBB. See, both of them are relatively the same type of fractal. There's some slight differences in weighting, but still, we like this. If healthcare breaks above 140, 141 with some vigor, which we thought was going to happen today, but United Health obviously got dunked on for earnings. Might be there next week. Who knows? We expect biotech to also be breaking out, and we want to grab some sort of exposure, right? Let's look at financials, because I think this is the most interesting sector right now. Obviously, tech's at all-time highs. Healthcare looks like it wants all-time highs. Industrials are at all-time highs. Financials are not yet at all-time highs, but they are breaking out of a 1.5-year base, this regional banking crisis, the banking crisis that never really fucking happened, right? We had a couple banks blow up, and that's it. JP Morgan absorbed them. And here we are potentially stamping out a new breakout after a 1.5-year base. We're seeing this in regional banks as well, although a little bit less magnitude there. We like our chances above $37, $36.5 within the financial sector. We're not afraid to be wrong, but the leading stock in the space right now is JP Morgan. So if we look at this on a line chart, I'm kind of cheating here a little bit because it had earnings today, gapped up 3% and then sold off. So we're right back at around break even on the day. Some might call that a failed news event and traded to the downside. We don't see it that way. We see the leading financial stock in the world breaking out into all-time highs off of supposedly good earnings. We'll see if over the next week or two this thing can reclaim its uptrend off of that earnings. The catalyst is already behind it, so we don't necessarily have to worry about some new news coming out. We like this, though. Above 170, we want to be long JP Morgan. I already have a large position in it at a 1.75R with a couple extra bucks on the side to buy a dip if it occurs. We like this particular stock. Also, caveat, if you superimpose JP Morgan on top of the S&P 500, they are very similar. So this is an important chart, not only for the financial sector, but also the market as a whole. The dollar, king dollar, obviously the most important chart. It's been the most important chart for the last 2 years. Primary uptrend, intermediate horizontal trend, short-term downtrend. We're expecting that if this continues to break to the downside and we get a definitive flush below 101 or 100, the primary uptrend is over. The inverse correlation between the dollar and the S&P 500 at that point should push the market into all-time highs. It's not that hard. You don't have to understand exactly why the relationship is inversely correlated. You don't. You just have to be able to identify it and trade off of it. Every time the dollar goes up, the market goes down, and every time the dollar goes down, the market goes up. It's been this way for 2 years. It's probably going to continue to be this way until it isn't. So continue to trade that. If the dollar breaks 100, primary trend is down. At that point, there's more juice to get into the S&P 500 in the market. Think about it from a risk-to-reward standpoint. Investors and traders, would they rather own the dollars or would they rather own the stocks? Dollars, stocks, right? So generally when dollars up on the day, the market's going to have a harder time going up. Right now you can see that the dollar is actually about break even, gold's up, and the market is about half up, half down. So whenever the dollar starts to catch a bid, you tend to see some weakness in the market, and then vice versa. When the dollar's down, the market tends to do pretty okay. TLT, really quick, the one thing I want to point out here is that generally speaking, in an inflationary environment, which is jury's still out, I think we are transitioning from a deflationary regime to an inflationary regime, and that goes like decades. It's not just a couple years, where bonds and equities trade in tandem. They're highly correlated. Right now, I don't know what happened last year in mid-June, mid-July, but if you look at bonds and stocks, they tend to move in the same direction, but the bonds tend to move first, right? So when bonds are moving up, equities are moving up. When bonds are moving down, equities are moving down. We can actually improve it to you. Just go out to the correlation coefficient, and if it's at 1 or above, you can see that last year, sometime in June or July, we flipped to almost positively correlated almost the entire time. You can see it used to be back and forth. The 60-40 portfolio was pretty good on this. And then all of a sudden we flipped positively correlated. Once again, that could mean that we're flipping from a deflationary into an inflationary environment. That doesn't mean inflation's going through the fucking roof, by the way. It just means that inflationary forces are greater than deflationary forces. So inflation can fall during an inflationary environment, and these intermarket relationships can still exist. It's amazing, right? The one thing I'm worried about, though, is the fact that TLT is failing to catch a bid as the S&P 500 is breaking out. We're currently trading below the 200-day moving average. I don't think necessarily we have a whole lot to worry about until TLT actually breaks down below 93, 93.5, and maybe this looks like a failed attempt at a breakout. Jury's still out on that, not entirely sure. But these are the things that keep me up at night. These are the things that I'm thinking about nonstop. Bond market is on a completely different level than the equities market, right? Can we all agree on that? Bond traders tend to rule everything. And so if the bond market is acting negatively in a positively correlated type of relationship, then I want to know, because maybe that means stonks aren't going to go up at the same vigor as we previously thought. Let's look really quick at BTC. As a matter of fact, I'm going to change it up. Let's look at Ethereum against BTC, and I want to point something out. This is a ratio chart showing you the strength of Ethereum against the strength of Bitcoin, right? I don't care what you think about Ethereum. I don't really care what you think about Bitcoin. What I care about, though, are relationships. And right now it looks to me that Ethereum, coupled with the BTC ETF, Ethereum might be about to outperform Bitcoin over an extended period of time. Don't know if it's going to be weeks, months, quarters, years. I have no idea. But inside of TTI, we were watching this support level. We're long Ethereum. We like the little undercut here. We thought maybe we were wrong. And then obviously over the last two sessions, it shot right back up with a lot of relative strength. What is that telling us? That's telling us that maybe Ethereum is about to start outperforming Bitcoin. And I don't want to say sell the news event, but the BTC ETF might have been kind of the catalyst for that, right? At the very minimum, maybe BTC's price movement is going to be muted. I have no idea what's going to go on, but I do know that Ethereum is now outperforming Bitcoin over the last 48 hours, and we do think that this is going to run for at least a couple weeks. And that opens up some trades, right? So let's actually talk through some trades really quick. Stock Uber. Been following channel long enough. You made a couple bucks off of TTI with Uber. All right, we had some free trades come out. First trade was above the 36.537 area pivot. The second trade was somewhere near 47.48 with $60 calls in March. You could probably still be holding those. Guys in TTI are still holding those. They're free, in the money. You're at all-time high. 3 months of expiration. These are probably going to be 1,000% winners if we're lucky off the breakout here, which I think we will be. But this opens up a new opportunity to enter new contracts off of the 64 pivot. We love it. This is an all-time high breakout above 64 in Uber. Right now, we're targeting the June $80 calls for no more than $2. Say that again. The June $80 calls for no more than $2. If at any point this particular trade trades for over 100% profit, sell half, let the other half run risk-free to the profit targets 80 and then 95. If we close below $60 on the other hand, we're going to want to close that trade and get anything we can back from it. A rebate. Don't let these things go to zero. The trade idea is dead if we break above 64 and then fall back within the range. Okay, so above 64, we like it to 80 and then 95 using the June $80 calls for no more than $2. CrowdStrike trade. You probably saw this in our live webinar as our quote-unquote perfect trade. This was 1,000+% winner for us after buying it off of the October dip. This was fantastic. Well, here we go again. This is a leading cybersecurity stock. It's a tech stock. It's a large cap tech stock. It fits everything that we think the market is going to continue to reward here. We don't want to buy it yet, though. We want to buy it off of the 295 pivot, the 296 all-time high. No idea what the contracts are, but this should be on your radar. Look for a break above this 295, 296, and then a pullback. Our price targets are first going to be somewhere around 335 and then 375, probably targeting the June or July's area as well. Just like Uber, you want like 6-7 months on these, right? Even with the 2.55 ADR into all-time highs, who knows if the market's just going to shoot straight up or not? It's probably not. So we want time on our side to be able to hold these things and actually realize the profit that we expect is going to happen. But this is a leading cybersecurity stock, and we love it. JP Morgan. Just want to talk through this. This is a stock that I'm 1.75 R in with another 0.25 R sitting on the sidelines. I like this stock. It's an all-time high. Financial related stock. I told you not only is this important for the financial sector, but it's also important for the overall market. They're very positively correlated, the S&P 500 and JPM, and we like it, right? A little bit of a pullback in towards previous overhead supply at 170. We're expecting this to start shooting up towards 180, 185 relatively soon. Now it's a slower ADR, 1.3, so we don't expect this to move 20% in the next 2 to 3 weeks. But we do expect this to be a nice base holder type of trade for the financial sector. Like I said, I'm heavy in this one in particular, so I'm talking my book, right? But we like it. All right, we like that 180, 185 price target, and then obviously up near 200 bucks if we can finally hit that. I have a plethora of positions. I don't remember if I have the June or July's, but I'm targeting the 180s. I mean, that's it. The 180s and the 185s. Talk my book, baby. Let's talk about the last one here. Ethereum versus... that's not the one I use. Let's use this one. Here we go. Ethereum versus Bitcoin. Stage 2 breakout. Right, classic Stan Weinstein, Richard Wyckoff stuff. We initiated on this way back when we were starting to break above, back in end of November, above 2050. That was really the call that we said. We said above 2050, we should probably grab some Ethereum, and here we are about 80 to 90% towards our first profit target at 2773. We like this. We expect this to continue to go up, specifically because Bitcoin is underperforming. I think the market cap in crypto is going to move in towards Ethereum to kind of capture the next leg up in Ethereum. Also, your altcoins that are Ethereum based should probably be running as well. So this is a good opportunity for those of you that are trading crypto or have your eyes on the charts for crypto to look for some altcoins that potentially run in tandem with Ethereum. Ethereum up and to the right. Bitcoin's coming down slightly off of the BTC ETF. We'll see how that ends up playing itself out. But those are the 4 trades we like. Uber, CrowdStrike, JP Morgan, Ethereum. We're bullish 2024. Please watch that video when it comes out. It should be the next video out on this channel. And guys, that's all I got for you. I appreciate you. Please like and subscribe if you like this type of content. I like making it for you. I had COVID last week. That's why I didn't come out. I missed you. It was a crazy week last week. It's a crazy week this week. It's a crazy week every week in the markets. We try to smooth it out and make it a little bit easier to understand what's going on. I appreciate you guys. Enjoy your weekend, and I'll catch you in the next video.